Hi, my name is Michael DeStasio, the founder of Valor Advisors. Today we're going to talk about common mistakes police, firefighters, and paramedics make with their Roth conversions. So we're going to learn about how this can be a way you can increase your tax-free retirement income. Before I begin, make sure to subscribe to our channel and like the video to help us reach more first responders. I'm going to start off with the Roth conversion definition. A Roth conversion occurs when you transfer money from a pre-tax retirement account, such as a 457B retirement account, which most first responders have through their workplace, into a Roth IRA. Now, this is what it looks like from a really high level. I'm going to go through a visual. You first have the money in your pre-tax retirement account. It can be any of these. You may be using one or multiple accounts, okay? The money is simply moved over to your Roth IRA. And that's what it looks like from a high level. Of course, there are other steps that go along with it, and we'll cover some of those in a minute here. Now, for the mistake of incorrectly estimating your future income. This is a mistake I see many first responders make when approaching a Roth conversion. So, estimating your future income sources is key in determining when and how much to convert. Okay, those are very important parts of the puzzle. So here's where many people go wrong. The first is having an inaccurate pension estimate. This could be because you didn't get a projection from the pension fund because you're near retirement, or maybe you miscalculated the cost of living increase, all those different things. Next is improperly estimating your spouse's income. Maybe they work a little less that year, a little more. They get a big bonus that you weren't anticipating, or you underestimated the bonus. So really eyeballing all those possibilities and coming out with a really solid number is really paramount. Next is not factoring in your rental income, dividends, or other income sources. All these different things matter. So knowing what they look like as much as possible will really help make this decision much better and more effective for you. Let's take a look at what this looks like for incorrectly estimating your future income. So maybe you guessed that your pension is going to be $85,000, spouse's income is going to be $97,000. Maybe there's some Social Security income. You might have gotten that from some side jobs that you worked throughout the years, or maybe your spouse is already claiming Social Security. All right, so you get $202,000 total income. So now you decide to convert money based on the guess, and then your actual income puts you in a higher tax bracket, costing you money. And that can be really just on some simple changes, right? So your actual income comes in a little higher with the pension. Maybe the spouse gets a bigger bonus than you thought. Maybe somebody has to claim Social Security throughout the year, or maybe the cost of living increase from Social Security is higher than you anticipated, right? All these different variables. Even this example, a small change of $30,000 might not seem like a lot of money to some, but that can really push you deep into another tax bracket. I've seen things as little as just a few $1,000s change in income, putting somebody into that higher tax bracket and really making the math on these decisions much different. The next mistake is not understanding that you owe taxes now. So converting the money creates a taxable event, and it does look like this. In this example, we're going to talk about no IRA conversions. Okay, so let's just say your household gross income is $300K, right, from whatever, all right? There is no IRA distribution, right, because that's part of doing a conversion. So, right, there's none of that. Simply put, $300,000 total income. We estimate $51,000 in taxes in that scenario, okay? Now, you decide to do this conversion and execute this, right? Let's say that number is $40,000 from your IRA. Right now, we have total income of $340K. Estimating the total tax due is $60,677. That's a difference of about just over $9,000, right? That's a significant amount of money to pay in taxes. And it doesn't matter if you're doing this when you're really young, earlier in your career, you have lower income, or you are much further along in your career, retired. You want to make sure, you have to understand that you will owe those taxes now when you convert, okay? And it might be painful to do that, but this will potentially allow you to grow your money tax-free longer and even bigger later in the future. So let's take a look at what this could look like if you're a new retiree, right? Maybe you decide to do a conversion in your early to mid 50s, right? We're going to let that money grow tax-free longer. We get multiple decades of tax-free growth then. Later on, you decide to use some of those retirement withdrawals for your long-term care, some medical expenses. Maybe you want to upgrade some parts of the house, give some gifts to your heirs, you name it, go on trips, right? All these different things. We can potentially have much bigger withdrawals later by compounding that money over time, create a much bigger nest egg and boost your quality of life. Now for the mistake of not filing your taxes properly. This is a very common mistake. I see this every single year with one of my new first responder clients. They may have done a Roth conversion. We do a tax review, and we find out that this was incorrectly reported. So here are some things to be aware of. You have to report this on specific IRS forms with appropriate lines and check boxes filled out, okay? So you really want to make sure that this is done correctly for your IRS reporting on your 1040 and all the associated forms. The next one is that your broker may list the wrong distribution code on your 1099-R, resulting in a tax penalty, all right? You might not even know this is the wrong distribution code, so having an understanding of what this could look like and what this needs to be is very important. To fix it, you simply go back to the broker, you let them know you have a conversation. They can issue you a amended 1099-R, okay? Sometimes tax preparers don't always understand the complex Roth conversion rules, right? They might not fill out the associated forms that go along with this correctly. They might not even catch that your 1099-R has the wrong distribution code on it, right? If they get this and they just enter the information based on what they see, that's all going to translate down to your 1040 incorrectly and be a potential tax penalty, which we want to avoid. Now for a summary of common mistakes on Roth conversions. With proper planning, you can save thousands of dollars in taxes and boost your retirement by avoiding these common mistakes, right? With your income sources, your tax preparation, and more. So if you'd like to learn if Roth conversions are right for you, then schedule a no-obligation retirement review by visiting my website, valoradvisors.com, or you can email me directly, michael@valoradvisors.com. I really hope you found this information helpful and informative. Please make sure to subscribe to our channel, like the video, helps us reach even more first responders. Thanks and have a great day.